So the index, this is indexed to 100, which I think was a 1980 number.
Shocking rising home prices and mortgage rates aren't giving home shoppers much to be thankful for these days. The national average 30-year mortgage rate lost a little steam in the first week of November, but by the end of October, rates had already reached a 23-year high of 7.79%, according to Freddie Mac. The 30-year fixed rate went down by 3 basis points to 7.776% in the week ending November 2nd. This was the first relief after 7 weeks of rate hikes. A basis point is equal to 1/100th of a percentage point. 2 years ago, mortgage rates were in the low 3% range. Because of high home prices and rates, the National Association of Realtors reports that monthly existing home sales have dropped for the 4th month in a row. In September, sales dropped by 2% compared to 0.7% the previous month, and all 4 major U.S. areas saw drops. Cathie Wood talks about her thoughts on the market, pointing out that the housing market is going down and that this is related to the financial problem. Now let's watch the movie. Please click like and subscribe and send us your thoughts below.
And look where we are. We're back where we were in the early 80s. The commodity prices have gone nowhere. And if you want to look at recent times, sure, you can see the supply chain shock that we went through that took this metric up from roughly 60, well, roughly doubling it, 60 to more than 120. But it's coming down now. It's down more than 25% from its recent peak. And if you look at it again, perspective is everything, since the 08-09 crisis, you'll see that it is in a downtrend. Deflation. Most people don't understand this. The Fed certainly doesn't seem to understand it. So we do not think the greater risk here is inflation. Commodity prices are the first place you'll see inflation brewing. And commodity prices are determined at the margin. So incremental demand relative to supply, which shot commodity prices up during the COVID crisis. And we had not only COVID, but the war in Ukraine exacerbating that supply shock. Now you have them coming down, and we don't know what's going to stop them from coming down further now, perhaps to the lower end of this range. Hopefully not lower, because that will be we'll be in more of a free fall situation, which of course we do not want. So that was interesting. The other interesting thing is the dollar. Again, a little bit of perspective. I started in the industry in the late 70s, and you can see in the late 70s, the dollar was at a low level. And in fact, the US was the laughingstock of the world. Our productivity was collapsing. The dollar was collapsing. We had very weak leadership in Washington. And then the combination of good fiscal policy and monetary policy in the early 80s took the dollar up dramatically to the point where it was causing great pain in the rest of the world. As the dollar was appreciating, their currencies were depreciating. Their purchasing power was going down, and they were servicing dollar-denominated debt with their own currencies, which did not buy as much of the dollar. So it became too onerous. And that was just way too high, too deflationary in the mid-80s. And you can see what happened after that. In the late 90s, the U.S. was quite the opposite of the late 70s. We were the superstar with super productivity growth and technology with the internet, the name of the game. So we had a terms of trade appreciation in the dollar, which was very good for the United States. And then we had the opposite of that, the tech and telecom bust and everything that came with it. And finally, the 08-09 crisis. And the dollar just was under tremendous pressure. But look what has happened since then. The dollar is up 40%. That is a powerful anti-inflationary force. And it has been in place now for 13 years. So there's a cumulative effect. And that is why we believe commodity prices have come down during that period of time in a trend sense, and have come down recently. So on to the next chart. And the dollar going up is very interesting. First of all, many of the bears out there have been expecting it to go down. Twin deficits, the budget deficit, the trade deficit. That was the same argument used in the 70s. You can add two other reasons the dollar should have gone down, many people observe. You can see that China is selling long-term treasuries. Its long-term treasuries have gone down from more than 1.3 trillion about a decade ago to less than 800 billion. And you can see at an accelerated rate during the last few years. And when we see these numbers going forward, given what's happening to the yuan and China's attempt to shore it up, what are they doing? They're selling long-term treasuries to get dollars. They get the dollars and they use it to buy their own currency. So they're putting those dollars back into the system to support their own currency, to prevent more depreciation. It's not working. They've been holding it around the 130, 131, 132 level. But we believe when we see these reserves, they'll continue down because they've had to protect their currencies with bigger and bigger sales of the dollar. And the dollar, by all rights, then should have been going down, all other things equal, but it's not. Why isn't it? It's a flight to safety vehicle. The dollar is a flight to safety vehicle. It is playing that role once again in the market as economies around the world are suffering from all kinds of things. China's suffering. Latin America, we see in Argentina, the inflation just is terrible. We've seen it in Turkey as well, how high they've had to raise rates. We have the war. We have the war in Ukraine, now in Israel. So a lot of risks out there. Another reason that the dollar is going up. Here's the picture of non-farm unit labor costs. The bears would have had you believe that this move up starting in 2010, unit labor costs were negative back then. Compensation growth was held down during 08, 09, and productivity actually increased. So unit labor costs were going down. They crossed over zero in mid-2015 and had been going up, and many people thought, okay, COVID, let the genie out of the bottle, and we did see unit labor costs go up as labor was so difficult to get. But just look at it now, down to 1.8% on a year-over-year basis. So unit labor costs takes compensation, both compensation and productivity, into account. So it's output per man hour, that's productivity, and unit labor costs are compensation costs less productivity growth. So we're at 1.8%. That's below this 2% inflation target. And the Fed has been very worried about the labor market causing inflation. This chart, this evidence would suggest that has not happened. It is not like it was during the 70s. Look what happened. We got into the double-digit range here, where we've just reversed. And I think this was an important indicator for the Fed this week. And I think they're a little bit more on high alert that they may be making a mistake here. They won't say that their vote this week was unanimous to hold for higher and pay attention to the data.
Some say horrible things keep happening. A Goldman Sachs report believes this home market crisis is worse than 2008 on certain levels. Mortgage rates are about 7.5%, the highest in 20 years because builders are not building enough homes and there aren't enough for sale. Home prices keep rising. The average U.S. sale price was approximately $500,000 in Q2 2023. The Atlanta Fed reported rising living costs. Typical home prices, income, mortgage rates, monthly principal and interest payments, and average mortgage payment income are tracked. In July 2023, housing costs had declined by over 8% year over year, but were still more than 31% below what most people could afford. I still worry about life in 2008. The U.S. government conservatively controlled Fannie Mae and Freddie Mac. Much has changed since then. 20 years ago, the biggest home market issues were different. During the last crisis, no down payment mortgages and cash out of home worth allowed more Americans to buy homes, raising prices. Fewer homes are for sale, hence prices are high. Both housing prices and mortgage rates are rising. People who want to buy a property but can't due to pricing are hurt. Home prices fell during the last crisis due to rising loan payments, not this time. Your thoughts on Cathie Wood's study? Tell me in the comments and like, follow, and enable alerts. Thanks for viewing.